Welcome to Talk Tickers. Today we're breaking down the third quarter earnings call for J.Jill, and this one is a perfect example of when good news, well, just isn't good enough for Wall Street.
All right, let's just jump right in, because this is really the heart of the whole story. You've got J.Jill putting up some solid numbers, right? Beating estimates on revenue and profit. But then the market just hammers the stock, sending it down over 13% in a single day. So what gives? What on earth did Wall Street see that they disliked so much?
So here's how we're going to break it down. We'll look at that paradox, starting with the numbers that, looked pretty great. Then we'll get into the guidance, the real reason for the warning signs. After that, we'll see what management plans to do about it, and we'll wrap up with our take on what comes next. Okay, so first things first, let's look at the numbers for the quarter that just ended. And honestly, on the surface, J.Jill knocked it out of the park. It was a clear beat, no doubt about it. Check this out. Adjusted earnings per share came in at 76 cents. Now, the street was only looking for 59 cents. That is a huge 17-cent beat. I mean, from a profitability standpoint, that is a really strong performance. And it wasn't just the earnings either. They topped revenue expectations too, pulling in over $150 million. Yeah, okay, it was still down a little bit from last year, but compared to what the analysts were predicting, a solid win. So, if the past quarter looked this good, you just know the problem has to be with what's coming next.
And that, right there, brings us to the guidance. See, the market doesn't really care about what you did yesterday. It cares about what you're going to do tomorrow. It's a forward-looking machine. And what management said about the next quarter, well, that's what really sent a chill down investors' spines. It really started with this one key quote. So there it is, right from the CEO's mouth. They're seeing a change in trend, a softer start to the holiday season, which, as you know, is absolutely critical for any retailer. And she blames two things. First, the market is getting super promotional, way earlier than usual. And second, the customer is just getting a lot more careful with their money. And this table, wow, it just lays out the damage perfectly. Look at the official guidance for Q4. Net sales are expected to be down 5 to 7%. Comp sales, even worse. But the real kicker, look at that adjusted EBITDA line for the fourth quarter. We're talking $3 to $5 million. That is a massive, massive drop in profitability. That is the red flag the market saw. Okay, so things look tough. The big question now is, what's the plan? How is management going to steer the ship through this? Let's take a look at their playbook. All right, their game plan seems to boil down to three main priorities. First, they've got to shake up the product assortment, bring in some fresh, new stuff. Second, they're working on the customer journey, basically moving away from old-school catalogs and doubling down on digital. And third, they want to get leaner and meaner by improving how the whole company operates.
And these aren't just buzzwords on a slide. They're actually doing things. For example, they're testing new stuff like faux leather and even some cashmere, and apparently it's working. They're also tailoring what's in each store to the local market. But here's what's really interesting. They created a brand new role, a chief growth officer, and their whole job is to spearhead tech and AI. That's a big move.
Now, this chart really puts everything into perspective, doesn't it? This whole situation isn't just a blip on the radar. Look at the last year. J.Jill's stock is down almost 50%, while the broader market is up double digits. That is a staggering difference. It tells you this isn't just about one bad quarter of guidance. This is a longer-term struggle, which is exactly why this new playbook has to work. All right, so let's put all the pieces together. What does this all mean for the stock? We're heading into our final section, the next call, with our rating and what we'll be watching for. So our official rating is going to be market perform. And what that means is we think the stock will probably just move along with the general market. Not much better, not much worse. Look, you have to give them credit for a really solid Q3, but that guidance for Q4, those are some serious headwinds that you just can't ignore. For right now, the risks and the rewards feel pretty evenly balanced. So when the next earnings report drops, here's what you need to be looking for. Number one, and this is the big one, gross margin. All those promotions, how much do they hurt profits? Number two is inventory. Management said they want to start the new year with a clean slate. Did they pull it off? And finally, we need to see some proof, some early signs that their new products and their pivot to digital are actually starting to move the needle. And that brings us to our plausible trade idea. Let's be real, the only reason to be bullish on this stock right now is if you believe a turnaround is coming. And the most interesting piece of that puzzle for me is that new chief growth officer. So here's the thought. What if? What if this new exec can actually use AI to make the company way more efficient, to get new customers in the door, and to create a whole new tech story around the company? If that happens, you could see the market get very excited very fast.
And of course, just a reminder, we're doing this for informational purposes only. This is definitely not financial advice.